For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future. Are we back? We're back. Wow. Look at this. Has it been a week already? I guess.
Quick.
Yeah. All right. Well, welcome to the show, Managing Your Financial Future. Sometimes I forget to say that title, too. I'm always so excited to get into the topic, you know. But people know the name of this show. It's right there. If you have the podcast title, you know this is Managing Your Financial Future. You probably know I'm your host, Johnny Dean. You probably know that other guy is Rick, the Professor Plum.
That's me.
Not a real professor, but a real certified financial planner and a real accredited wealth management advisor.
One of these days you'll get that.
You know I'm messing with you when I do that.
Yeah, you say that now.
I just wrote it a second ago. I'm working on a bio for you. Do you realize that? I am. Rick is going to, by the time people hear this, it's going to be over. But in a couple of weeks, you're going to be speaking to a Rotary
next week.
Crowd. Yeah, next week from when we're recording. And you're going to be talking about what estate planning or?
Oh, QCDs to start. And basically how qualified charitable distributions and charitable giving doesn't necessarily stop when you do. You also need to, coordinate your estate plan with your charitable giving if you're charitably inclined.
Yeah, and things we've talked about on this particular program. So hopefully after that, you can tell them we have a podcast and they can listen to Managing Your Financial Future. How's that?
I will bring that up.
Okay, all right. And it's not on the actual radio anymore. It used to be you just tell them what station to tune into. Anyway,
you had to remember what station and what city because we were on so many different stations across the U.S.
We were on as many as 60 different markets back.
More than that.
I think it was 60 markets.
Okay.
Or 60 stations. I don't know what it was, but it was a lot. Those are the good old days. But now we don't do the over the air. You just do podcasts. Now you're everywhere.
Yeah.
Everywhere. It's kind of nice. And that's good because it gives you a lot of reach, and it also allows us to speak on topics like the one coming up today. Today is, boy, I tell you what, when we talk about the accumulation phase versus now decumulation is kind of a word we made up. We'll call it the distribution phase. When you talk about these two things, it seems to me that when people discuss finance and they discuss planning, they spend most of their time and effort talking about the accumulation phase. In other words, how to get rich.
The creation of a net worth.
Right. Get how to build as much as you can so that your nest egg is large enough so you can retire as soon as you can. That seems to be where most of these strategists tend to focus their time because people want that. It's sexy. It's something that they can get there.
And it's important.
Well, it is important. Absolutely. No question about that. But it's a little bit like, being a coach and on a basketball team and only telling them how to play offense and never talking about playing defense and how to prevent bad things from happening. It's more about let's score as much as we can. Here's how we're going to run up the score and we're going to do this. I mean, coaches don't do that. They're going to teach both ends. And when it comes to financial planning, I think both sides need to be taught. When you're talking about the accumulation phase, Professor Plum, that's kind of your offensive phase, right? Try to get as much as you can. I mean, you know what I'm saying.
Well, yeah, I look at it as you cannot have a distribution phase unless you've had an accumulation phase.
Correct.
Unless you've accumulated a net worth that then can be turned into a distribution.
But what gets ignored or at least shoved off to the side is the distribution phase, because I think what people think is, well, once I reach the number, I $1 million, $2 million, $500,000.
Oh, the latest reports, now I can't remember who, Northwest Mutual, not was of them, but they said to be happy in retirement, you need $1.4 million.
$1.4 million to be happy in retirement?
Yeah, to have a successful retirement, you need $1.4 million. That's the number. 2 years ago or a year ago, it was $1.2 million. So we've had a little inflation in that area.
Don't even know what that means. But you know what? I could have $1.4 million, $1.2 million and be happy. But if happiness to me means spending of that $1.4 million means spending $140,000 a year to maintain my happiness, that's not going to work. So I want to talk today.
It'll work for a little while.
It'll work for a little while, but not as long as I hope. So I want to talk today about the differences between the accumulation phase and the distribution phase and why it is two separate skills.
Well, and the average advisor looks at the distribution phase, as an extension of the accumulation phase. You work your way up to
Exactly.
That date where you retire, you're financial independent, whatever you want to call it, and you start then taking money out of the portfolio,
Right.
but you really don't change your overall investment strategy. You've gone from a pure stock investor when you're 25 years old to a balanced investor when you're 60, 65 years old, and you stay a balanced investor until you become 100 years old, and at that time you should be all cash.
Because
you're
100 minus your age.
is-
Yeah. Well, okay, let's separate these two. We'll talk first about the accumulation phase. And this is, as I said, gets more of the attention. Talk for just a second, Professor Plum, about what people need to know as far as the accumulation phase. You know, I hear about young people being told that they need to rebalance their 401ks, and they need to have, you know, maybe a set of, you know, be 30% bond and 70% stock. Professor Plum, can you set people straight as to what you believe the accumulation phase should entail?
Well, the most important thing about the accumulation phase is to get started. And the earlier, the better. And obviously, the more, the better, because it doesn't matter what your investment thesis is if you don't have any money in the investment thesis to go up or down or whatever the case may be. You have to get started, and the earlier, the better. And I think that making it systematic, automatic, taking it away from you having to actually remember to save the money is going to help you tremendously. That's why 401ks work as well as they do. We sign up for it, we forget about it. And and then the money just comes out of our check. We don't even notice it. It happens, and that's why I think the auto sign on,
the auto contribution, whatever,
and the auto increase of contribution as it goes along. Those are very important because we tend to not do those on our own. So creating a net worth, and the reality is whether you choose XYZ growth fund or ABC growth fund or DEF growth, pick a growth fund. And you do that for 30 years, the difference isn't going to be too dramatic with a good growth fund, no matter what it is. I mean, whether it's the cheapest one on the street or one that's middle of the road expense. Okay, yeah, a good performing, lower cost, long-term mutual fund is going to, or ETF, however you're looking at it. You don't have to pick the best one.
Yeah.
Because you don't know what the best one is until you look back at it after 20, 30 years worth of growth. Just pick a good one and get it moving for you. That's the hardest part about accumulating a net worth, is to get it started and get it working for you. Now, where people make the mistakes in accumulating net worth is they buy into the idea that it's a one-stop shop. You only need your portfolio should be, the same, or it should, be a target date idea that as you get closer to the target date, to the day that you want to turn the income on, or till when you eat your goal, that you do become more conservative with the entire overall strategy. Meaning not only do your current investments become balanced, but all new ongoing contributions go into that same portfolio. One stop shop.
You see that as
one
a
portfolio
mistake.
Morphs into a more conservative portfolio, which it should do by the time you retire. If you're continuing to save money into that one portfolio, you're not taking advantage of the markets.
I'm not sure people necessarily know exactly what you mean. When you're talking about this, you're saying that as your portfolio becomes more conservative, and that would mean that the aggressive portion, let's call it.
You go from 100% stock to maybe 80-20 stock bond.
Whatever.
70-30, 60-40. By the time you get to retirement, you want to have a less conservative, less volatile.
You mean less volatile, more conservative.
Volatility is a fact of life when it comes to investing. And so we have to find out how we can use or protect ourselves against that volatility. When you're young, that volatility is one of the greatest things you've got going for you. Dollar cost averaging, putting money in systematically, your 401k and such.
Yeah.
Because when the markets go through downturns, you buy more shares because you're putting in a constant dollar amount, but they're cheaper, so you can buy more.
Dollar cost averaging.
And then when the markets are high, you don't buy as many shares. But over time, these things all average out, and you have a lower entry point on average than you would have otherwise. The problem is if you go to retirement and then turn around and start taking money out of the portfolio, you're getting a lower transaction point there too. But that's a sale. You don't want that.
Yeah, we'll get to that in just a moment.
When you're going through this, yes, you don't want to be 100% stocks by the day you retire, because the day after you retire, the market could go down precipitously. and now you don't have enough money to basically retire. And from an emotional standpoint, you freak out and you sell and you lock in the loss, and then you're complaining the rest of your life. So as you get closer to retirement, yes, you do become more conservative. Some of the money should be in safer, less volatile, fixed income, stable value, cash, CDs, treasuries, more accessible liquid money than stocks. But the money, if I'm not going to retire for another 2, 3, 4, 5 years, the money that I'm putting in today, the money that's coming out of my paycheck, going into my 401k, my Roth, my investment, my ongoing investment, that's not money I'm going to spend the day I retire. That's already in place. The money I'm saving today, if I'm retiring 3 years from now, is the money I'm going to spend 20 years from now.
Yeah.
That should be taking advantage of the dollar cost averaging. That should be going into an all stock portfolio.
Okay.
So you change from a one portfolio fits all approach to, yes, I'm going to morph to a more conservative overall portfolio as I get closer to my goal date. But the new money I'm going in, I still want to use the volatility to my advantage.
All right. So
because I know the only thing the market's going to give me for a guarantee is volatility.
So to encapsulate this, if I went from 100% aggressive stock portfolio, as I get older now, maybe I'm a few years from retirement. Now I'm 60% stock, 40% non-volatile. I don't know, just whatever.
Yeah.
I'm still putting, let's say I've been putting $2,000 a month in for, that's my 401k. Putting $2,000 a month in. Well, now that I'm 60% stock in this example and 40% bond, that $2,000 a month, which used to go all the way across the board to...
So if you just put it into your same overall portfolio, 40% of it's going into low volatility or no volatility.
And I don't
assets.
want to do that. You're
not
saying,
getting any bang for your buck there.
You're saying take that whole $2,000 and put it only into that stock portion.
Yeah, 100% stocks.
Yeah, that's what you mean by
right.
that. And that's an important thing.
You safen up existing assets.
Yeah.
You dollar cost average into volatility.
Some 401ks, and I know the one that I'm in right now, actually default to that. You have to change that. They will default to, okay, your new contributions, your new contributions.
Oh, the same as,
right. So if I safen up, which I've done as I've gotten older, but if you safen it up, it's saying it still leaves the new contributions going into the aggressive
right.
side.
As you get closer to your retirement date, there should be a difference between your current allocation of existing assets and the future allocation of contributions.
So do you see that as the biggest mistake that people make in the accumulation phase?
No, the biggest mistake is
not doing
starting.
It. Yeah, that's true. Okay.
Beyond that, the next thing you need to do is look at what you're trying to accomplish and use what the world gives you to your advantage. We know the markets are going to be volatile. There's nothing you can do to stop that. So let's use that volatility to our advantage, but also protect the assets that we're going to spend in the not too distant future from that volatility. Mm-hmm. Volatility is not risk. Your application of how you manage that volatility is where the risk either comes in or you protect against it.
Such an important point.
And that's where buckets controls all. But just the general idea, your portfolio gets more conservative as you get closer to retirement. And then how you distribute assets becomes a different game. But we haven't gotten to that point yet. We're still just accumulating wealth.
Yeah.
Use what the markets are going to give you
and allow time.
Protect what you have to protect.
And allow time to do what it does. Yes. And I think that's the important point here. Honestly, Professor, just before we get on to the distribution phase here in a sec, when you're putting money into your portfolio, I mean, there aren't a lot of tricks. You see people say, well, you're going to need to sell at this point. And we're going to have to buy point here. And you're going to keep doing this stuff within your 401ks. And, make sure you'll
micromanage your way to a lower return that way.
It seems to happen that way as they try to incorporate market timing, and they try to different algorithms that can tell you when to buy and sell. I mean, honestly, Professor, do you see that as a problem too for people?
Well, not everybody, because the reality is most people put it in their 401k and forget about it.
And that's the good thing about it.
But this is where I don't agree with target date funds, because if all you're using is a target date, maybe your target date is 2030. You're only 6 years away from retirement. Well, that target date may be 40% bonds, and if that's the only fund you're using, your ongoing contributions are going into 40% bonds or 40% cash, safety, low volatility things that don't take advantage of dollar cost averaging. So if you're going to use target dates, and unfortunately a lot of 401ks have gone to the majority of their options are target dates. Yes, you can use a target date for the existing money, and as you get closer to it. But the new contributions, put that in your 2080 fund.
Yeah.
The longest fund you got there.
We don't really care for target dates. In some ways,
You
it's
can
like
use them, but
it's like investing 101. I don't know. To me, it's kind of just not.
Well, it's an attempt to make it
Easier.
one-stop
Yeah,
shop,
yeah,
easy
yeah.
for anybody. But you leave something on the table if you don't use them correctly.
So there's a correct way to do this whole accumulation thing. I want to switch over now and talk about what happens when you reach that number.
The distribution
phase. And once again, I hate to repeat myself, but I'm going to, because this gets ignored by way more than a few people who don't understand how your distribution method can help or hurt you in a big, big way because of this volatility.
And the majority of people out there just use the distribution as an extension of the accumulation, and they don't make any changes. They use the same portfolio. Sure, you're going to have a balanced portfolio, 60-40, 50-50, whatever it is. But you don't take distribution. Just like when you're adding money to the portfolio, you add the money to the volatility to take advantage of that volatility. Mm-hmm. When you start taking money out of a portfolio, you do not take it from a volatile source because you do not want to reverse dollar cost average. You want to make sure that the money you're taking out now is not being sold at a loss, thereby locking in that loss.
Here's what I think a lot of people do. You can back me up. They may be 50% stock, 50% bond, let's just say, for simplicity, at retirement. And maybe that's the right allocation, I don't know. But they do that, and they say, okay, well, I'm retired. I got my $1 million. $1 million bucks. I'm a millionaire. I can retire. I'm going to take $40,000 out because that's what I do.
4% rule.
I'm going to take $40,000 out of this portfolio. So I'm going to withdraw just across the board. I'm going to sell off some stocks and sell off some bonds or whatever I have to do.
I'm just going to take it out of the portfolio. The portfolio is going to automatically rebalance.
Right. So I will just take it out. Some of it's stock, some of it's bond. I don't really care. Right. Send me a check and then rebalance the rest so that it's 50-50. That is a huge mistake in your opinion.
Sometimes it can work. If the market goes up and up and up and up and up and
up. But it doesn't. So that makes it a huge mistake.
At some point, the market comes down.
Yeah.
Now, if the market, and this is where timing, the future sequence of returns, we've talked about sequence of returns, what happens in the next 5 to 10 years will have a dramatic effect on your viability of your portfolio. If we go through a 10-year period of time where the market just goes up every year, you're probably going to be fine for the rest of your life. If, on the other hand, in the next 10 years, your first 10 years of your retirement, taking your 4%, whatever your distribution is, you have a couple, 3, 4 bad years, even or zero or lower than zero negative years, the viability of your portfolio drops off dramatically.
Yeah.
Because you're selling when it's down. To get that same $40,000 a year, you have to sell more shares of something to get that $40,000 because the price is so low. Well, that money can never recover. And volatility helps long-term returns, but it can really screw up a short-term distribution strategy.
Yeah. So people are saying, well, heck, I need $40,000 a year. I've got my, you said be conservative. So I've got 50% stock, 50% bonds. I'm 65 years old. I've got to take my $40,000 because that's what I need to live off of, above and beyond Social Security and whatever else I have. But I need that. So Professor Plum, what am I supposed to do?
Don't use a balanced portfolio for your distribution. You can be 50-50. Now, there's better ways to do this. This is a very simplistic. But okay, fine. You got 50% in cash and fixed income. Take your $40,000 from that side of the equation and only rebalance if the markets are on a tear on the upside.
You would prefer.
Wait for the opportunity that the markets give you. Use cash and other lower yielding, low volatility or no volatility assets to buy time for the markets to do the negative things that they do to us from time to time.
Now, if you saw that and they said, "Look, I've heard about this buckets thing. Tell me what you would do instead."
Well, I would back into the appropriate allocation by looking at how much you need to spend. You wanted $40,000 a year.
Yeah.
So I'm going to take maybe 25-30% of the money, depending upon how risk tolerant or risk averse you are, and put it into CDs, T-bills, laddered out, so that I have $40,000 available to me every year for the next 7 years.
So that's about what, $280,000. $280,000 of my million now is going to go into something what you just said.
Exactly. And then I'm going to take maybe another $280 and put it into. Now this is where a balanced portfolio can actually work. I'm going to put it into a balanced portfolio that I'm not going to touch for the next 7 years. I don't need to. I know I got my $40,000 plus some interest coming from my bucket number one. The safe accounts, T-bills, laddered, coming out at the right time.
I have my income.
I've got my cash flow. It's not going to change for the next 7 years. I've got it. So now I use a balanced portfolio for the next 7 years, and I can accept a little bit of volatility, because if it goes down in the first year, it's got 6 years to recover. If it goes down in the second year, it's got 5 years to recover. I'm monitoring it. I'm looking at it. I'm watching it. And over that period of time, it should do better than what I was earning on bucket number one. And even in a year like 2007 to 2009, where an average balanced portfolio did take a hit. This was back in the great financial reset. Average balanced portfolio went down more than 20%. But by the end of the 7-year run, they were up 7, 8, 9% on average per year. They recovered very nicely. So if I had to sell out in the first 2 years, I was in big trouble. But if I waited long enough, now the stock market, as a pure stock market play, did not recover quite as quick. And there are times where we need more than 7 years for the stock market. The 2000 to 2009 time period, stock market went down tremendously 3 years in a row, and then by 10 years later, we were just getting back to where we started with at the end of 1999. So we've got our bucket number one for the money we're going to spend for the next 7 years. We've got bucket number two that can be used to refill bucket number one
after the 7-year period is up,
which means that the rest of the portfolio, the remaining $440,000 in my example, can be invested for growth, for pure stock market. If you look at the overall portfolio, we're more 50-50, but we're not taking distributions from the overall portfolio. We're taking distributions from the appropriate investments that lead themselves to being a distributable asset.
You are 55-45, basically, somewhere in there.
Well, if you look at the balanced portfolio, it's got, half stock, half bonds,
right.
Maybe, 55-60%, 60-40.
Right. But you're letting that grow because you don't need to touch it for the next 15 years.
And I'm leaving that $440,000 in bucket number three alone, potentially for 15 years. Am I really leaving it alone for 15 years? No, I'm monitoring it, because what I've done is I've created a plan against the negative volatility that the markets are going to potentially give us at times. But by monitoring it and knowing where I expect to be, I can look at it and say, this is not a negative volatility. This has been a positive volatility. The market's up 20% a year for the last 3 years. Maybe I take a little bit out of the cream, a little of that extra return.
And buy yourself a little more time.
I mean, if I expect bucket number three to earn 10%, I start with 440, I expect it to go up 44,000 the next year, and then 46,000 the next year, and so on down the line. I expect it to be, $600,000 3 years from now, or some number. I've done the math exact. What if it's 700? Do I just say, I'm all in? I'm going to stay all in. You can. You got 12 more years for it to roll. Or you might say, you know what? I don't need to be totally greedy. Let's take some of that extra and move it over to bucket number one or bucket number two, thereby safening up my overall portfolio.
And buying yourself
time. Advantage of what the market gives us. We've already protected against what it can take away from us. Let's look at taking advantage of what it gives us. That's the whole premise of buckets. That's the beginning point. So it is an asset allocation tool. You're allocating your assets according to need. I'm matching my assets to my liabilities. My liability is that I need to spend money. And the asset backing that depends on, when do I need to spend that money? Do I need to spend it next year? That's a short-term liability. Do I need to spend it when I'm 85? Well, for me, that's still a longer-ish term liability. It's getting closer every day, but that's a good thing, right?
We won't get into that.
Now, if I'm 84 and I need to spend it when I'm 85, that's a short-term liability.
Sure.
But it's all a matter of identifying. And that's why, like last week's podcast, we talked about the foundational income that we create with Social Security and pensions.
Yeah.
Understanding how much we want to withdraw from our portfolio is very important in determining how to invest that overall portfolio. Creating a plan that is based on you, your income, your needs, your desires, your risk tolerance. There are some people that don't like seeing negative numbers. And so the stock market is not necessarily a good place for them to play with any of their money. And that's fine as long as you have enough to do what you want to do. Obviously, your rates of return are going to be lower, but there are those that just don't like negative numbers. Well, and there's other people that say, 15 years, I don't need a 15-year. Let's make it a 10-year, 5 and 5 instead of 7 and 8. Those are discussion points, and those are all about tailoring your specific strategy to you personally.
What it comes down to is having enough cash flow, because really in retirement, that's what it's all about. Having enough cash flow. You need to have enough. You're retired. You don't have a paycheck coming in.
Not only do you want that cash flow, you want to make sure that you don't have to worry about it and that it's not going to go away. And unfortunately, the so-called 4% rule, the idea that, well, once you start it, if the market goes down, reset it to a new 4% of the lower number. Well, that means I have to take a pay cut. Yeah. That's not a good strategy. Or just don't spend any money until it recovers to where it should have been. That's a horrible strategy. So all of the strategies around how to manage your distribution in a typical balanced systematic withdrawal approach suck. It's just the way it is. How do we get past that so we can create a cash flow that we want and not have to have anxiety when the markets go down like they did in 2022? And the reality is, even in good years, there's some time during the year, in almost every year, where the markets are down at some point. Yeah. Sometimes more than others. And it can still be a positive year. Going way back into the Wayback Machine.
I know. 1987, yeah.
I mean, that October was dreadful. Was it 20% in a month or more?
Yeah, or so? Less, yeah.
But for the year, from January to December of 87, was a positive year in the market as measured by the Dow and the S&P.
But it gives people a lot of stress and
anxiety. It creates a lot of agita.
And the idea that somebody who retired in 2020, 2021 pandemic, I mean, that was a time for some people to just say, all right, I'm done.
That was a lot of stress.
Right. But you were doing okay. But then 22 comes along. And the markets start going down. Interest rates start going up. Somebody with a stock and bond portfolio, both of them are now down.
We had massive inflation and lots of negative returns.
Right. The COVID, the reverberations from COVID created all that. We had no way to plan that other than be ready in case something happens.
We don't know when the markets are going to crash. I mean, why did the markets crash in 2000? Was there an event? We all thought it was going to crash. Heck, even Greenspan talked about it in 1996 when it went on for 4 more years.
No, nothing happened to create. It just did.
It just happened. And then what happened in 2009 at the bottom of the market, the financial reset, to start the market going back on a positive note? There was nothing that happened that you can pinpoint and said, oh, that's why the bottom happened that day. We cannot pick the top or the bottoms. We don't know when they're going to crash. We just have to be prepared for them when they do.
Because if you have your income, you have your cash flow, and it's not going to be interrupted by things like a bad stock market, you might look at it and say, well, stocks are down. I wish they were up.
No, the biggest question for somebody who's truly bucketized is, especially if it happens real early. So you bucketize the end of last year. We're a couple months into the year, and the market goes down. I mean, it goes down a lot. And you've got 6.5, almost 7 years worth of safe money on the sidelines. It's like, oh, this is a buying.
I've got some cash.
Should I take year 7 money and buy in? Because the market's down. If the market were down 20, 25%, or you're looking at this from the end of 21 through 22, you're saying, I've got a lot of cash on the sidelines that, should I be buying in right now? Taking advantage? Now, it's hard to do because we never know when the bottom is actually going to happen.
But that's a discussion you can have with your advisor.
When you're truly bucketized, you're looking for opportunities.
Yeah. You're not afraid.
You're okay.
You're not afraid.
You're not afraid of it. You're looking for, how do I take advantage of this?
Yeah. Well, that's why we're such big proponents of it. And some of the criticisms that I've seen, and over the years, although I see a whole lot less now, I've seen a whole lot less criticism of buckets. It started to taper off back in the 2008, 2009. That. And then again here in 2020, when we had all the volatility and all that stuff, and 22, I see a whole lot less. But generally when they're criticizing this type of approach, it's because they're not doing the buckets correctly.
Right. Or they're saying it's too complicated. Well, losing money is very simple, and it still stinks. So if this is it's not too complicated, by the way. It's fairly straightforward and fairly easy to do.
In concept. Now, the execution of it requires somebody who knows what they're doing.
Right. But and that's actually the beginning of buckets is the allocation of how much goes into safety, this and that thing. But then there are other steps on top of that, and that is asset location.
And we've talked about things like that before.
The tax planning, trying to control one of the biggest expenses that you have that we all hate, which are taxes.
Yeah.
If we can reduce taxes, that means we have more free cash flow to spend on the things that we really like ourselves.
Isn't that what it's all about? This discussion boils down to this. It takes one set of skills and it takes one type of strategy, a different type of strategy to do the accumulation phase, and a completely different one to do the distribution phase.
They're not an extension of each other.
No,
they are different.
Absolutely different. It's like I'll say the playing offense and defense thing. You can play offense one way and then you got to play defense another way. That's just the way it is. This stuff is called buckets, and we've been doing it for a long time. We've been talking about it for a long time. Folks at Lucia Capital Group have been doing it for a long time. If you want to know more about buckets, we have this guide.
Handy dandy.
It is both handy and dandy, and you can get it at luciacap.com, luciacap.com. You go there. There's a search bar up in the upper right. Type in buckets or bucket strategy, something about bucket, and you'll see it. It's a resource. It's a downloadable guide. Tells you about the bucket strategy, and it'll tell you. It's about 30 pages or something. But for some people who want the too long did not read, shorter version of it, you can read the first probably 2 or 3 pages.
It's in sections.
That
build upon each other.
But the gist of it is contained in the first few pages.
Yep.
And you can understand it right then. And then you can dig deeper into it if you so desire. Go there. It's all free. You can download it right now at luciacap.com and type in bucket in the search bar, and then you'll see it. I would highly suggest you do that, especially you've been listening to this podcast, and longtime listeners have been too. If you have questions about buckets and how it works, that should answer it for you. And if not, you can get in touch with us here at luciacap.com. Professor Plum, you are the Chief Financial Planning Officer for Lucia Capital Group, so you've seen a lot of plans over the years.
Yep, I've seen a lot, yes.
And a lot of scenarios over the years. And we haven't seen it all, obviously, because we don't know what's to come.
We come upon new things all the time.
But you're confident that with the right strategy, you can weather just about anything.
True.
Go to luciacap.com, luciacap.com. Get in touch with Professor Plum or any Lucia Capital Group advisor, 800-644-1150, 800-644-1150. Talk to them. Get your strategy done. If you haven't done it yet, have somebody go over your portfolio. Just check. Is everything right? Is everything, are you on schedule? Can you retire when you want? And can you maintain the income, the cash flow in retirement that you need? Find out, 800-644-1150. Subscribe to this podcast. Do so immediately if you have not done so. Listen every single week. You'll get great episodes like the one you just heard. Go to Apple Podcasts or Spotify and subscribe, and make sure you take notes. Now, you don't have to take notes. You know what? You're going to learn stuff. You will, just by osmosis, as I did.
You did.
I did.
30 years of this.
30 years, that's right. Professor, thank you so much.
You're very welcome.
As always, I appreciate it. For Professor Rick Plum, Certified Financial Planner Professional, CFP Professional, I'm your podcast host, Johnny Dean. Thanks for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstance. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. We cannot assure the accuracy or completeness of these materials. The information in these materials may change at any time and without notice. This material should not be considered a solicitation of an offer to sell or buy any specific security or offering. Investors should consult a financial professional to determine whether risks associated with an investment in the shares are compatible with their investment objectives. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. Benefits may be subject to change at your employer's, the governing pensions, or benefit organization's discretion. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. A dollar cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. It is important to keep in mind that investments in fixed income products are subject to liquidity risk, interest rate risk, financial risk, inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the
full faith and credit of the U.S. government, but are subject to inflation risk. Target date funds are subject to the volatility of the financial markets, including equity and fixed income investments in the U.S. and abroad, and may be subject to risks associated with investing in high yield, small cap, and commodity-related foreign securities. Principal invested is not guaranteed at any time, including at or after target dates. Before investing, carefully consider a target date fund's mutual funds, exchange-traded funds, investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus, which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Dow Jones Industrial Average is a price-weighted average of 30 significant stocks traded on the New York Stock Exchange and the NASDAQ. The DJIA was invented by Charles Dow back in 1896. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.